Hello people, today we are going to learn about statement of cash flow. So let's get started. What is the purpose of statement of cash flow? It provides information about the cash receipt and cash payment of a business entity during the accounting period. It helps investors with the questions about the company, ability to generate positivity to meet its obligation and to pay dividend, need for external financing, and investing and financing transaction for the period. This is an example of a statement of cash flow. Cash flow statement is always given in three kinds, like cash flows from operating activities, cash flow from investing activities, cash flow from financing activities. In each of them, we list the individual inflows and outflows, and then compute the net cash provided or used by that kind of activities, and then we at the end we calculate the net increase or decrease in the cash. Then cash and cash equivalent beginning at the balance at the beginning of the period, and then by deducting or adding this value we get cash and equivalent balance at the end of the period. So as mentioned before in the earlier slide, the cash flows are classified into three sections: cash flows from operating activities, cash flows from investing activities, cash flow from financing activities. So let's see what all involves operating activities. Inflows from sales to customers, interest and dividend received. These are operating activities example. And in case of outflows, suppliers of merchandise and services, employees, a lender for interest, governments for taxes. So all these are operating activities. These are set of inflows example and these are outflows example. They all can constitute cash flows. Inflows are always added, outflows are always deducted. Let's see investing activities. In investing activities, inflows come from selling investment and plant asset, collecting of principal on loans. And outflows happens due to payments to acquire investment and plant asset, purchase debt or equity, investment, make loans. These are the inflows are added and outflows are deducted obviously, and these all constitute investing activities. What are financing activities? Inflows for financing activities involve short-term or long-term borrowing, owners, for example, from issuing of stock. And in case of outflows, the activities involved could be repayment of borrowed funds, owners for dividends, purchase treasury stock. Inflows are added and outflows are deducted, and the net value, cash values, are from the financing activities. So guys, these are examples of financing activities inflows and financing activities outflows. Cash and cash equivalent. What are cash equivalent? Short-term, highly liquid investments, readily convertible into cash, so near to maturity that the market value is unaffected by the interest rate changes. So based on these things, you can decide which are the things in your company which is cash equivalent. Cash flow from operating activities. The operating cash flow section can be prepared using either the direct method or the indirect method. So let's first look at the direct method. In case of direct method, cash received from the customer, accrual basis revenue includes sales that did not result in cash flow, can be computed as whenever there is a sales, uh, decrease in receivable is added and increase in receivable is deducted, and the remaining value which we get is cash received from the customer. Why decrease in receivable is added? Because we have already got that particular cash amount, so that particular cash is should be added. If we sell something and customer gives us cash, that means cash receivable is is decreased. So we have already got the cash for the receivable. That cash should be added and to the cash received from the customer. And if somebody buys from the credit card, that means out of this net sales, we have something which is not cash now and it is in the account receivable. So for calculating the cash amount in the net sales, we should decrease the increase in receivable to get the cash received from the customer. The account receivable balance was 80,000 on December 31st, 2002 and 110 on the December 31st, 2003. If accrual sales revenue for 2003 was 90,000, what was the cash basis revenue? So net sales is 900,000. So we know the formula as we learnt in the last slide. We have to add the decrease in receivables and deduct the increase in receivable to get the cash received from the customer. So what we need to do here is we have seen that the 80,000 was the account receivable in 2002 and then it became 110,000, which is increase in receivable account receivable. That means we have not received extra 30,000 of cash which we have earned as a revenue, but it is we have not received the cash yet. That means there is increase in account receivable. So what we have to do, we have to deduct from the net sales because we sold this much value, but we have not received the actual cash. So what we need to do is whether we have to deduct the increase in account receivable because we have not received this cash yet. So the resulting value will be 870,000, which is cash received from the customer out of the all net sales. So in case of interest received, what we have to do, we have to for calculating interest received, interest revenue plus decrease in interest receivable, and in case of increase in interest receivable, we have to deduct it. In case of dividend revenue, we should add the decrease in dividend receivable and deduct the increase in dividend receivable. In case of purchases, cost of how to calculate the purchases, cost of goods sold plus increase in inventory and deduct the uh, cost of goods sold plus increase in inventory minus decrease in inventory. So in case of cash paid for merchandise, we have to calculate the cash paid for merchandise. We have to add decrease in accounts payable with the purchases or deduct the increase in account payable with the purchases. So you need to remember these formulas for making it easy. Let's do an example to understand more. How much did Lug Light pay for the inventory in 2003? In 2003, inventory was 130,000, accounts payable was 23,000. At the end of December 2003, inventory was 165,000, which is an increase in inventory, and accounts payable is 35,000, which is increase in accounts payable, and cost of goods sold is 900,000. So first we have to calculate the purchases. So purchases is adding the increase in, first we have to calculate the purchases of 2003. So what the formula for purchases of 2003 is cost of goods sold plus increase in inventory. So cost of goods sold is 900,000 and increase in inventory is 165,000 minus 130,000. The inventory is increased, which is 35,000. So adding 900 plus 35, which is increase in inventory, is the total purchases of 2003. Because cost of goods sold, the goods which we have sold, the cost is 900,000, and since we have increase in inventory, that means we have purchased some extra item which are still in the inventory which is not sold yet, so we have to add that value, so it will give us the total value of the purchases for 2003. So now we have to calculate the cash paid. Cash paid is what? Purchases minus increase in the accounts payable. So purchases is 935,000 as calculated here, and then there is an increase in accounts payable. The increase in accounts payable is 35,000 minus 23,000. If you deduct it, you will get 12,000. So since there is an increase in accounts payable, cash payable will be purchases minus increase in accounts payable here. Cash paid for merchandises purchases minus increase in accounts payable. Why there is increase in accounts payable is deducted? Because we have not received the cash. We have not paid the cash, accounts payable. We have not paid the cash. We have bought this particular item with our credit card. So we have not paid the cash yet. So unless and until we pay that cash, it's not it doesn't come under cash paid. So total purchases which what we have done with the cash should be given as a cash paid. We are yet to pay the increase in accounts payable, which is 12,000. So if we deduct from the purchases, we will get the actual cash paid for this particular year, which is 923,000. After deducting depreciation and other non-cash expenses, the cash paid for the expenses is affected by whether the expense was prepaid and whether the expense was accrued. So cash paid for expenses plus increase in prepaid expenses and minus decrease in prepaid expenses, then plus decrease in accrued liabilities and increase in accrued liabilities. So for cash paid of expense, we have to use this formula. This is smudged a little bit, but you can make out, I guess. This is another example. This is the comparative. Whenever you have to calculate the cash flows, every time there will be 2 year given, two successive year given for the compare, which is also called comparative balance sheet. So this is the assets for the comparative balance sheet for this particular company for 2002 and 2003. So we can see that the cash has increased, account receivable has increased, inventory has decreased. So similarly, we can make one table here which will give us the increase or decrease in each of the factors here. Similarly, for liabilities and equity, 2 year is given comparative balance sheet. We have to make one more column which will give us whether there is an increase in accounts payable or decrease. Here, accounts payable is decreased. That means we have paid the cash, and that's why the account payable has decreased. Salary payable has decreased. That means we have paid the salary. Interest payable has decreased. That means we have paid the interest with the cash. Similarly, we have to make here a column so that we will be able to understand what is decreased and what is increased in the successive years. For this is the income statement for the 2003, which gives us the sales revenue, cost of goods sold, etc. for the calculation of cash flow. These are the additional information given, which is the cost at trading securities at cost of 25,000. Equipment with a book value of 40,000 was sold during the year 43,000. Then equipment with a book value of 30,000 was destroyed during pre-flood in 2003. There was no insurance. Great Big holds a 25% investment in tiny company and accounts for using it in the equity method. Then again, some more additional information is given. Tax rate 40%, notes payable at 12%, bond payable carry 9% interest. Sold stock for 50,000 in 2001, received 10,000 dividend from Tinyco. So cash received from customer. So how well can we calculate the cash received from the customer? Well, first we know that the sales revenue is 800,000, which is given in the income statement here. 800,000 is the sales revenue, and we can find out the increase in account receivable from the balance sheet. A comparative balance sheet, which is decrease in 8,000. Increase in accounts receivable is 8,000. Let's see in the balance sheet. Sorry. Here, account receivable increases 35,000 minus 27,000 is 8,000. So there is an increase in account receivable. So whenever there is increase in account receivable, that means we have not received the cash yet. So whatever we have sold, whatever cash we have not received, we have to deduct to find out the actual cash we have received. So cash received from the customer is 792,000. So this is how we have to calculate cash received from the customer. Cash paid to employee. Since there is a decrease in salary payable, we have to add it. A salary payable. How much is the decrease in salary payable? There is 2,000 decrease in the salary payable. Salary expense is 2,000. Decrease in salary payable is salary expense is given is 80,000, and decrease in salary payable is 2,000. So we have to add total and cash paid to the employees 82,000. Why we have to add decrease in salary payable? Because this decrease is because we have already paid in cash. So what amount we have paid in cash, which is 2,000. So since there is a cash transaction, we have to add to the expense. So 80,000 plus 2,000 is 82,000. Similarly, cash paid for the inventory, we know that the cost of goods sold is 560,000. If you go back in the sheets, then you will be able to see this is given 560,000 cost of goods sold. Then since there is a decrease in accounts payable, you can see in the comparative balance sheet in the payable liabilities and payable comparative balance sheet, there is a decrease in accounts payable. What we have to do in decrease, we have to add it. So we have to add the decrease in accounts payable, which is 3,000, which will be added to the cost of goods sold. So why we have to add the decrease in accounts payable? That decrease in accounts payable means we have already paid the cash throughout the credit purchase. So since we have paid the cash, there is a cash transaction. So it should be added to the cost of goods sold because we paid the cash to get the goods. So this should be added. Decrease in inventory should be deducted because that inventory is already sold and it is already included in the cost of goods sold, so we should decrease it in the which is $30,000. So the cash paid for an inventory is 533,000. Cash paid for interest expense is already given 28,050. There is a decrease in interest payable and we should add it because we have already paid the 4,600 in cash. So we should add it in the interest expense. So cash paid for interest is 32,650. Similarly, cash paid for taxes. Income tax expense is given 27,980, and there is a decrease in tax payable. So we have already paid the taxes in cash, so we should add this as tax expense, and then the total cash paid for taxes will be 30,000. So other operating cash flows will be dividend from the TinyCo, which is 10,000. Dividend we received is 10,000. Then purchase from trading securities because we purchased and gave out the cash, so it will be deducted. Other operating expense means we have spent some cash to get the things done, so we should deduct it, and then we should calculate the net cash flow from the other sources, which is negative in this case. Now we have to add all of them together, which we calculated step by step, and then whatever value we got, we add or subtract, and we get the net cash flow from the operating activities for this example. So what is the value? 27,370, which is here, operating activity cash flow. Similarly, for investing cash flow, we know that the equipment book value was 40,000, but in the additional information, if you go back, you will find that in additional information, the book value is given as 40,000 and it was sold at 43,000. The proceeds from cash sales will be 43,000. For financing cash flows, we have read in the additional information proceeds from the sale of stock is 50,000, and principal paid for bonds. Since it is paid, there is an outflow of cash, so it is deducted. Principal paid on notes, since it is paid, then it should be deducted, and then net cash flow will be. If you calculate all these, you will get this answer. This is 110,000, 50,000 minus 110,000, which is minus 60,000. You add these two and deduct 60,000, you will get 10,370. And notes payable decreased from 70,000 60,000 during 2003. If you go back, you will know how to calculate this. I mean, you see the comparative liability balance sheet, and you will see that notes payable decreased from 70 to 60 during 2003, and that's how you get 10,000 here. And then we add the, for calculating the net cash flow, we add the beginning cash balance, which was 60,000, then ending cash balance will be 60 plus 10 is 70,370. 70,370. So operating cash flow is 27,330, 370, which we calculated. Investing cash flow we also calculated. Financing cash flow we also calculated. Beginning balance cash flow it's 70,000. Ending balance is 70,370. So guys, I hope you got some idea on the cash flow direct method. In the next tutorial, we'll discuss about indirect method, which most of the company uses. If you are new to my channel, subscribe or come back to my channel for more videos on accounting and other things. Thank you for watching.